Hello. Today is Tuesday, June 9th, 2026. Here is your daily signal. Gold prices dropped sharply, according to Bloomberg, as strong U.S. labor market data spurred expectations of renewed Federal Reserve rate hikes, rippling across both bullion and bond markets. The U.S. labor market data, including non-farm payroll reports, are critical in influencing Federal Reserve policy decisions. Recent policy shifts by the Federal Reserve, such as changes to interest rates or forward guidance, directly impact the pricing of gold and U.S. Treasuries. Gold is typically viewed as a safe haven asset during times of economic uncertainty, while bond yields move inversely to bond prices and are sensitive to Fed signals. Market participants closely monitor monthly labor statistics to anticipate central bank action and subsequent movements in gold and bond markets. Specifically, after the June 8 U.S. payroll report, Bloomberg reported a sharp rise in gold prices, while Reuters noted that 10-year Treasury yields dropped to 3.47% following dovish Fed guidance. CNBC added that Federal Reserve officials signaled a pause in rate hikes for June, responding to signs of moderating job growth. In the near term, gold may sustain its gains as investors seek safety amid labor market uncertainty. Bond yields may remain low if the Federal Reserve pauses rate hikes, possibly increasing demand for treasuries. Looking further ahead, volatility could return to gold and bond markets as labor data and Fed policy continue to shift, ultimately affecting capital flows and broader asset allocation strategies among institutional investors. Next, we take a closer look at how government deficits are influencing the cost of homeownership. Fortune reports that the U.S. federal deficit, now climbing by $3.4 trillion, is a major force behind persistently high mortgage rates, as the Treasury's ongoing debt issuance puts upward pressure on yields. The U.S. Treasury issues debt to finance government deficits, impacting financial markets. Higher Treasury issuance can push up yields, especially on 10-year Treasury notes, closely tied to mortgage rates. Mortgage rates often move in tandem with Treasury yields, making housing less affordable as rates rise. Surge in deficit-driven debt issuance follows both pandemic-era fiscal stimulus and ongoing federal spending. The Federal Reserve adjusts its policy in response to bond market conditions, which in turn affects mortgage rates. Major mortgage lenders like Wells Fargo and J.P. Morgan Chase are also navigating the effects of Treasury yield volatility, with homebuyers and real estate investors bearing the brunt of higher monthly payments. Government agencies including the U.S. Department of Treasury and HUD play essential roles in oversight. In the near term, sustained Treasury supply may keep mortgage rates elevated, raising costs for new borrowers and weakening housing demand, potentially exacerbating affordability issues and slowing home sales across the country. Longer term, a prolonged period of high mortgage rates could hold back new construction and weigh on U.S. economic growth, possibly prompting policy moves aimed at supporting affordable housing or reducing the overall debt burden. Next, let's explore how advances in artificial intelligence are reshaping the software development landscape on mobile devices. According to Hacker News, Zedra has introduced a new mobile platform that allows users to control AI coding agents directly from their smartphones, marking the latest push in mobile-first AI code generation. Mobile-based AI coding agent platforms enable users to generate, test, and deploy code using artificial intelligence right from their mobile devices. These platforms harness large language models, such as GPT-4 from OpenAI, Anthropic's Claude, and Google Gemini, which interpret natural language prompts and generate code accordingly. The mobile AI coding market accelerated in 2023, with over 20% of new developer tools released as mobile-first solutions, fueled by widespread 5G adoption and improved on-device AI processing. OpenAI just launched a beta version of its GPT-4o mobile coding assistant for Android, dramatically expanding code generation capabilities in the palm of your hand. Meanwhile, GitHub Copilot Mobile, announced on June 8, now adds multimodal support to iOS, enabling developers to prompt code via voice or even images. In the near future, these mobile AI platforms could boost productivity for freelance and remote developers, especially those in emerging markets, and may challenge established desktop integrated development environments as a younger generation of developers goes mobile first. However, new risks loom. Increased coding on less controlled devices could introduce fresh security vulnerabilities. Additionally, complex workloads that outstrip current mobile hardware could drive up cloud computing costs for providers, as more processing shifts to remote servers. Now, onto the markets. European markets were mixed, with Germany's EWG edging up slightly and France's EWQ advancing by 0.4% to outperform on the day. The UK, represented by EWU, showed a marginal uptick, while Italy's EWI stood out with a notable 1.05% gain. Spain's EWP fell by 0.2%, and the Netherlands' EWN led gains internationally with a 1.6% rise. Chile's ECH dropped 1.5%, marking a significant decline, while Belgium's EWK slipped modestly. Australia EWO and China large cap FXI each posted mild losses. Japan's EWJ surged 1.36% to lead Asia, and Taiwan's EWT outperformed with a 2.4% gain. Among commodities, gold was fractionally higher and U.S. oil posted a 1.6% increase, but platinum fell 1.6% and silver was nearly unchanged. In the U.S., the S&P 500 gained modestly, while semiconductors soared nearly 5.9% for the session, with stocks leading sector gains. Healthcare and real estate saw slight declines, whereas transportation stocks rallied over 1.5%. In the favorites list, AMD jumped 5.1% and Intel rallied by over 11%, while Adobe and Microsoft both edged lower. That's it for today. You can find more news and details on our website. Goodbye.